Withdraw $4,000 in the month, your portfolio drops 30%. Those shares are sold at the bottom, and they are not coming back in any recovery. And if that money came from your IRA, every dollar also lands in your adjusted gross income, which, if you're drawing Social Security at the same time, can pull a slice of your benefit into taxable territory and is building toward a Medicare premium surcharge 2 years out. The market hits the portfolio. The IRS hits the income, both at the same moment. The market side of this has a name: forced selling. Technically, sequence of returns risk, not in the drop itself. In the sell low that the drop makes necessary. It hit retirees entering 2007. It hit people retiring into 2001. And a retirement plan that draws exclusively from a single investment portfolio, with no separate cash reserve or income floor, has nothing else to spend when the market drops and the bills do not. Retirement income researchers have identified a way to build a firewall using an asset most retirees already own: their home. I am your guide to real-world retirement decisions on this channel. In the next 15 minutes, the forced selling mechanic, the HECM credit line as the firewall, the 3 myths that keep most people away, and what it actually costs. One feature of this tool almost nobody explains correctly: the line of credit you open does not stay the same size. Under the HECM formula, the unused line expands over time at the same rate the loan balance would accrue, tied to the loan's current interest rate plus the mortgage insurance premium. Leave it untouched for a decade, and the available credit is substantially larger than when you opened it. And every dollar you eventually draw is a loan advance, not income. Not counted toward Social Security taxation, not counted toward Medicare premiums. That combination is what makes this worth understanding precisely. Before Part 1. If this is the research your advisor has not walked you through yet, hit like and subscribe now so these videos keep reaching you. Part 1. The mechanics of the damage. Let me put the sequence problem in plain numbers. 2 retirees, same age, same $500,000 portfolio on day 1, same $4,000 monthly withdrawal, same long-run average return over 30 years. The only difference, retiree A retires into a down market in the first 3 years. Retiree B hits the same rough stretch 15 years in. Same average returns, same dollars withdrawn, same allocation. By year 30, retiree B still has money. Retiree A ran out well before then. The reason is mechanical. When you withdraw from a declining portfolio, you're selling more shares than you would in a stable environment. If the market drops 30%, every $1,000 you pull out now requires selling roughly 43% more shares than it would have before the drop. Those extra shares sold at the bottom are not there when prices recover. They are not there to receive dividends. And because withdrawals continue through the recovery, the bills still arrive next month and the month after, you are selling into the rebound with a progressively smaller base. Retirement income researchers have identified the historical start dates where this damage played out most severely. The 4% rule was stress-tested against the worst 30-year return periods in United States market history, retirement starting in 1929, 1937, and 1973. Each of those periods shared the same structure: sharp early losses that forced selling at depressed prices before any sustained recovery arrived. They did not fail because long-run average returns were bad. They struggled because the bad years came first, and withdrawals made the damage permanent. Historical data on American equity returns shows that the best 40-year stretch for a consistent investor produced more than twice the final wealth of the worst 40-year stretch, using identical dollar investments throughout. That gap is not explained by investment decisions. It is entirely a function of sequence. One more thing most people do not anticipate: the vulnerable window does not begin on your retirement date. The research points to the 2 to 3 years before planned retirement as nearly as exposed as the years immediately after. A major drop at the end of your working years, when contributions have slowed or stopped and the timeline to recovery is shorter, can cause almost the same structural damage. None of this means you should not retire. It means a plan with no backup source of spending, no cash bucket, no income floor, nothing outside the equity portfolio, has no automatic protection against a forced sale. The buffer does not have to be home equity. A cash reserve, a short-term bond ladder, an income annuity, an unused Roth account. All of these can serve as spending sources outside the portfolio during a rough stretch. The HECM line is one version of this. What makes it distinctive is how it is funded, how it grows while untouched, and how the tax treatment works when you draw from it. Here is what I want you to know before we go any further. There is one ongoing obligation in Part 4 that has ended more of these arrangements than any other factor. Know it before you talk to a lender, not after. Part 2. How the HECM credit line works as the buffer. HECM stands for Home Equity Conversion Mortgage. It is the federally insured reverse mortgage available to homeowners who are 62 or older, backed by the Federal Housing Administration. The basic terms: you borrow against your home equity, owe no monthly principal or interest payment as long as you live in the home as your primary residence, and keep current on property taxes, insurance, and maintenance. And the loan becomes due when you sell, move out permanently, enter a skilled nursing or similar care facility for more than 12 consecutive months, or die. The buffer strategy is built around the HECM line of credit, not the lump sum, not the monthly payment stream. Here is how it works. Early in retirement, ideally at or near 62, well before a market disruption, you open a HECM credit line against your home. You do not draw from it. You leave it as a standby reserve while your investment portfolio operates normally. When markets are up, you draw income from the portfolio as planned. When markets drop significantly enough that selling would lock in real damage, you pause the portfolio withdrawals and draw from the HECM line instead. The portfolio is left alone to recover. When markets stabilize, you resume portfolio withdrawals, and the HECM line sits again as a reserve. Think about how this compares to a conventional cash bucket. You set aside 2 or 3 years of living expenses in a money market or short-term bond account, completely separate from your equity investments. When the market falls, you draw from the cash bucket rather than selling stocks. The HECM line serves the same purpose, a reserve outside the equity portfolio that covers living expenses during downturns, but without requiring you to pre-fund a large block of capital in low-yield assets. The credit line draws on home equity only when needed, and the available credit grows while it sits untouched. Whether the portfolio is sold at the bottom or left intact to recover makes an enormous difference over a multi-year rough patch. 3 features give the HECM line specific advantages as a buffer asset. First, the tax treatment. HECM draws are loan advances, not income. They do not count toward your adjusted gross income. They do not count toward the Social Security provisional income calculation, the formula the IRS uses to determine how much of your benefit is taxable. They cannot push your modified adjusted gross income over a Medicare premium surcharge threshold. Compare that to an IRA withdrawal in the same down market year. Every dollar from the IRA lands in your AGI, and, depending on your income picture, can pull a portion of your Social Security into taxable territory right alongside it, plus potentially trigger a Medicare premium increase 2 years later. A HECM draw in the same situation generates no taxable income at all. And if you have spent time thinking about how IRA withdrawals interact with provisional income, you already know exactly how valuable that is. Second, the available credit grows when the line is left untouched. Under the HECM program structure, the unused portion of the credit line expands over time. At the same rate the outstanding loan balance would grow, tied to the loan's current interest rate plus the mortgage insurance premium. This is not the lender offering extra credit. It is the mechanics of how the program works. Open the line at 62 and leave it unused for a decade, and the available credit is substantially larger by the time you're 72. This is a core reason the research consistently argues for opening the HECM line early in retirement. At the start, not when a crisis has already arrived. A line opened at 62 builds a larger buffer by 75 than the same line opened at 74 during a downturn. And at 74 during a downturn, your home may also have declined in value, which further limits what is available to draw. Third, the loan is non-recourse. The maximum you or your heirs will ever owe is the sale value of the home at the time of repayment. If the outstanding loan balance exceeds what the home sells for, from a rising loan balance, falling home values, or both, the federal mortgage insurance through FHA covers the shortfall. Your investment accounts, your savings, and the rest of your estate are not at risk. If the home sells for more than the outstanding balance, the surplus belongs to your estate. Heirs who want to keep the property can purchase it at the lower of the outstanding loan balance or 95% of the appraised value at the time of repayment. Part 3. 3 beliefs that stop people before they start. Belief 1. This is a product for people who have run out of money. This is the most persistent misunderstanding about reverse mortgages, and it does the most damage, because it routes the conversation away from the households the strategy is actually designed for. The buffer asset approach requires a real investment portfolio worth protecting. It is a planning tool for someone in a solid financial position who wants a way to avoid selling depressed shares to pay the bills in a bad year. Retirement income researchers have placed the HECM buffer alongside income annuities, guardrail spending strategies, and bucket systems as a planning tool for before the crisis, not a rescue plan for financial distress. Belief 2. The bank ends up with the house. You retain title. The lender holds a lien, the same as any conventional mortgage lender does, but you own the home for as long as you live in it as your primary residence and meet your ongoing obligations. When the loan is eventually repaid, any equity above the outstanding balance belongs to your estate. If the home sells for $500,000 and the outstanding loan balance is $200,000, the $300,000 difference goes to the heirs. The lender receives what it is owed and nothing beyond it. Belief 3. The proceeds are taxable. They are not. HECM draws are loan advances. The IRS does not classify them as income. They do not appear in your adjusted gross income, your Social Security provisional income, or your modified adjusted gross income for Medicare premium purposes. The reasons are the same ones covered in Part 2. Loan advances are not earnings. Whatever the tax picture looks like in a down market year, a HECM draw does not add to it. That distinction between taxable and non-taxable sources of retirement income matters precisely because the wrong choice in the wrong year can end up costing more than the market drop itself. Part 4. What this actually costs and what can go wrong. Upfront costs are real. A HECM loan carries an origination fee to the lender, a mortgage insurance premium to the Federal Housing Administration, and standard closing expenses, appraisal, title, legal. These are typically drawn from your available home equity at closing rather than paid out of pocket, but they represent real equity being consumed at the start. Get a full written loan estimate, treat the cost as what you're paying for the buffer, and run those numbers against the protection the buffer provides before you proceed. Mandatory counseling is required before a HECM can close. You must complete a session with a housing counselor approved by the Department of Housing and Urban Development, someone independent from the lender. This is a genuine consumer protection, a federal requirement built into the HECM program because earlier reverse mortgage products had a documented history of aggressive sales practices. Take the session seriously. Use it to understand every term of the loan, every repayment trigger, and every ongoing obligation before you sign anything. The loan balance compounds over time. Interest accrues on the outstanding amount and grows alongside it. The longer the loan is in place, the larger the balance, which means less equity potentially passes to heirs. The non-recourse feature protects your estate if the balance exceeds what the home sells for, but the compounding is real, and heirs should understand the full picture. The property must be maintained. Property taxes, homeowners insurance, and any homeowners association fees must stay current. Falling behind on property taxes is consistently cited as one of the most common reasons HECM loans are called due before the borrower expected, frequently enough that HUD's consumer guidance treats it as the primary servicer default risk. This is an ongoing financial obligation for the life of the loan, not just a closing day requirement. I do not want that surprise to arrive for you on a Tuesday morning 10 years in. HECM draws have no effect on Medicare eligibility or on the taxation of your Social Security benefit. However, Medicaid operates by different rules. If you currently receive Medicaid or may need it in the future, how your state counts HECM proceeds can affect your eligibility. This varies by state. Confirm the rules in your state before proceeding. Here is the one thing to take from this. The largest structural risk in the early years of retirement is not your investment allocation. It is being forced to sell depressed assets to fund living expenses before the portfolio has had time to recover. Any plan that puts a buffer between your portfolio and that forced sale, a cash bucket, an income floor, a guardrails spending strategy, or a properly structured HECM credit line, is doing real, measurable work. Shares left untouched in a recovery keep compounding. Shares sold at the bottom do not. The HECM credit line is one tool. It is not right for every household. It is not the only answer to sequence risk. It comes with real upfront costs, real ongoing obligations, and a counseling requirement that exists for a good reason. But it is not a last resort. For a household with meaningful home equity, a real portfolio to protect, and a long retirement ahead, it belongs in the conversation. And that conversation is far more effective before a market downturn, not during one. This is not financial advice. Every situation is different, and a decision this significant deserves a conversation with a qualified, fee-only fiduciary who knows your complete financial picture. For a product with this level of complexity, a HUD-approved housing counselor before you sign anything is not just a regulatory requirement. It is where the real decision gets made. Use what you learned today as the foundation for those conversations. If this gave you a clearer picture of how the buffer strategy works, drop the word buffer in the comments below. It tells me this topic is useful and helps more people find this content. Hit like before you go and subscribe if you have not already. I am your guide to one real retirement decision at a time, and the next one is already on its way.